there's a way to resolve that. Essentially, if you use the market cap, for example, you have the problem of running into the fact that you're using the actual price in your calculation of price, which you shouldn't be doing. It should be completely intrinsic. And so, and those two, well, shareholders' equity would be doing the same thing, right?
No.
Well, okay, sure, they won't. But there's an official way of doing that. There's an official way of doing that, which I will show you in a second. Okay, return on equity, use that formula again, CAPM. Return on debt, or this is the percent debt, so it's basically the percent that is debt of the company. Return on debt you can find on Bloomberg or what I put up here, investinginbonds.com. You just look at their corporate bonds and you look for about the same maturity as you have the risk-free rate, so 30-year bonds if they have any. And then this is the tax shield. Now the reason that's in there is because interest payments are tax deductible. So basically a corporation will pay interest on their debt, but then they'll take that out of taxes. It's a little bit tricky how that's incorporated. If I were you, I'd just use the formula. You can figure it out later. All right. So as I said earlier, you have all of that, and it needs to be discounted by WACC, right? And so the discounting formula, of course, is net present value, and then you'll get a lump sum, which we call enterprise value. So only problem here is when you're discounting, what do you do with the arrow? It goes on forever, right? So how do you discount something that goes on forever?
Take a perpetuity.
Take a perpetuity. And what's the general formula for perpetuity?
C over R.
Yeah, so C over R. Now, so cash flows.
This is correct. This is something so C over R minus G.
Yeah. So in this case, you'll have 100% going into perpetuity, right? Or not 100, $100 going into perpetuity. And then R, what would you use for R?
WACC.
Yeah, well, you'd use R for WACC. But the only thing is a company will also grow into perpetuity, right? So, and you're right, it's C over R minus G. Like that. So you take the last cash flow, in this case it's $100, or you take a cash flow that you think is reasonable into perpetuity, and then you divide it out by WACC minus G. What should you be using for G? Opinions. What do you think? How quickly does a company grow into perpetuity?
Well, presumably. Wait, what? Sorry.
I mean, I think you have to take into account a lot of factors, whether it's like in the growth stage of the company, whether it's at like the lower stages of the company where the growth's really slow, like what the market things are like.
Right. So okay, so you can do that, but also into perpetuity. Remember, this is forever.
Like 3%.
So like 3%. Okay. So the thing is, how fast does the American economy grow?
3%.
3%. So if a company grows faster than the American economy into perpetuity, what's going to happen?
It's going to explode.
Well, yeah, it's going to basically take out the entire American economy, which doesn't sound very reasonable. So basically, use something between 0 and 3%. You might even use 0%. So like in the last 10 years, it's grown 0. Well, a little more than 0, but not much. Okay, and so be reasonable. Don't use more than 3%.
So like if you were modeling Google, you would use less than 3%.
Yes. Although I think the people who do model Google don't necessarily do that. Like I noticed Pandora, you guys use Pandora. They're making an IPO, and like for the next few years, they're assuming a 178% growth rate, just because in 1 year they had a 178% growth rate, which makes the value of the company completely crazy huge. But like they grew, but I don't think they're going to continue growing because they just don't see where the profits are coming from.
Didn't in the DCF or AMD, didn't they use a G of like 6?
Yes, they did. But what they did a little differently. They had it in tiers. So basically, they had this, and then they had like 2016 to 2025. They assumed a little bit higher growth rate, and then I think they trailed off to a lower growth rate. But the thing is, they had reasonable assumptions. So basically, I would say if I normally saw a 6% growth rate, which is why I asked them, it's like that doesn't sound reasonable. And then they showed me what their logic was with like the markets they're going into. And I could see maybe in China having a 6% growth rate for a while. Maybe. Okay. But that's still questionable. So basically you get, like, after the sum of all of this, you get the enterprise value. It's basically the net present value. You take all of these cash flows that are coming in there, and And now, how from here do you think we get the share price? And of course, if you look down at your sheet, it will tell you, but or you can figure it out yourself. So first of all, as I mentioned earlier, you put cash, right? Because companies keep just cash on hand. And the trick with that is it's assumed that they'll eventually pay all the cash out. And that's why you add that in. So they have cash on hand. But now, so that's the entire value of the company. That's like the corporation. Huh? Okay, so the enterprise value, that's on this side, is basically the net present value of all the cash flows into WAC, right? So that's the enterprise value. It's the value of the company, and as I have it written here, it is the sum of all future profits in the company in today's terms. So that's what you're assuming will go to the shareholders into perpetuity. And then they also have cash on hand, which you think will also go to the shareholders into perpetuity. And then, so this is basically that corporation picture on the first slide. So who does this belong to?
Debt holders and shareholders.
Debt holders and shareholders. So you take out the debt. You can get the debt off the balance sheet, and then you take out the equity, right? And so what's left is the equity here. And so this needs to go to shareholders. So what do you do to figure out how much it is for each individual share?
Divided up by the total number of shares issued and outstanding.
Yep, and that'll give you what it should be, the price per share. So that's basically the logic of a DCF. Now there's one problem, as Richard brought up, and this is something I drew in a completely irrelevant computer science thing, but it's a DCF, so it'll work. So what do you notice about the green things? What is the one green thing that you would need the market price to calculate, or you would need to figure out how to calculate? Well, you don't really need, you need historical market price to calculate, right? You don't need the current one.
Equity?
Yeah, it's the equity, right? Because it's unclear because you're trying to value equity, but you have equity up here. And so basically the consensus on how to do this with DCFs to keep it as a contained thing, not to use market prices, is you can actually permutate this, right? This, you can iterate to this. So as long as the green box equals this box, it'll be right. So basically that. So you need to use solver in Excel or goal seek, for example, to make sure that those two cells equal each other. And then it'll be right. And actually this is mathematically solvable and it's okay. So that's a little bit tricky, but you'll see how it's done.
Question.
Yeah, that was quick.
I'll ask my question slightly differently. Why don't you just use the book value of equity as reported by the company on the balance sheet?
So the book value of equity would be just the assets minus the liabilities, right? I would say you wouldn't use that just because this way, well, I don't know. I'll have to think about that one. I'll tell you the next time, or Dirk will tell you. Oh, by the way, Dirk is teaching a thing next class, which is also DCFs. I'm sure he'll talk more about the thing that I kind of glossed over, which is that part, which is important. Okay, so basically that's the logic of DCF.
One more question. Why does there seem to be just browsing through Google between Investopedia, NYU Stern School of Business, and a whole bunch of other places, a sort of a debate as to whether you use the risk-free rate calculated from like a roughly 10-year Treasury bond versus the 1-month the 3-month T-bill?
Well, it's all about investment horizon. But as I said in my last lecture, what you're using to discount as a discount rate should also reflect what other people are using as a discount rate. But that being said, it depends on your investment horizon. I don't think you should ever use a 1-month T-bill because that doesn't really make sense unless you're investing in a very short amount of time. You should, well, mostly it's a question of a 10-year versus a 30-year. I know, for example, in investment praxis, the MBA class where they manage a lot of money, they average the 10-year and the 30-year. I wouldn't use a 1-month because, well, even in WUSIF our horizon is bigger than that. Other stuff? Questions? Yeah.
Coming off of that then, if we were going to discount cash flows for a period, let's say period, 2 years in the future period, 5 years in the future period, 10 years in the future, would it be advantageous to change our risk-free rate to reflect the rates for bonds that match those exact time horizons?
Change the risk-free rate?
Yes.
Oh, for Treasury? Oh,